He is the chief investment strategist at BMO. He is entering the cauldron. It's good to see you. Welcome to the program.
Thanks so much for having us.
Is that what we call it now?
That is.
It is right now.
That's what it has become today. Bang, growth. You want to stay with growth stocks in this market?
I want to be in selective growth. We have the good fortune of running 7 portfolios for Beemo, 5 in Canada and 2 in the United States, and we're overweight communication services, and we own Facebook. The problem is that there's still a scarcity of ideas that are giving you that type of growth. Now, the concentration in these FANG stocks and the growth stocks isn't what it was last year. Okay, we've seen a broadening out of the rally, and we wrote a piece about value this week. And I have to say, from a fundamental perspective, value is screaming as a buy. But last week I had a great meeting with a client in the Midwest, and he's a value manager, and he's looking over his shoulder waiting for the guy to walk through the door with the severance package because value investing has been down for a long time.
That's right.
And it reminds me.
But why is that going to change now?
Well, it's going to change now because you're at these levels where everybody's so worried about valuation, right? And if you take a look at those companies, just very simplistically, that are trading below 15 times, and the average next 12-month PE is 16 times, these companies have dramatically underperformed. Oh, by the way, they're back down to these 1998 levels, Scott, when I remember as a strategist going into Fidelity trying to pitch value stocks to the Fidelity portfolio managers, and all they were buying was growth. So we're at that type of psychological
Brian, value
low.
is measured by what? Because the problem you're going to have if you want to use traditional metrics like price to book or book to market, however you want to measure it, is that all of the things that matter in today's economy do not show up in book. Brand, IP, user base.
Right.
Those are the metrics that drive stocks higher now or lower.
Well, it's a great point.
And the book to market stuff is honestly not working. Hasn't been working.
It's a great point. That's why I didn't mention it.
Okay.
Right? Because if you take a look at the Russell 1000 value, you've got 32% financials, right? And so the market
high book value to market.
So
not helping.
It's difficult. So I think what the moral of the story is, quite frankly, is the market is a market of stocks, right? And I think we've entered into the early stages of a fundamental, actively portfolio traded market, where you're buying brands, you're buying management, you're buying cash flow, you're buying R&D. It's stocks. It's not about value or growth.
How are you measuring value, though?
Well, how I measure value is different. I look at stocks that are trading below the market PE, that have earnings above the market PE, that price to book below the market, and have debt to equity ratios that are going down. I don't want to buy a value trap based on my Merrill Lynch training that I had.
So overall, the market, your target on the S&P is 3,000.
Yep, has been all year long.
You've been bullish for about as long as I can remember, and rightfully so. I mean, you haven't even seen a bear suit in your closet.
I have. Many people forget that.
I'm not saying that's a bad thing, but I mean, you've stuck with your conviction that through the peaks and the valleys that we've witnessed and the upset that's felt bad, that everything was fine, that we're still in the midst of what is a still growing bull market. Is that fair to say?
Yes. Now, we originally put our first bullish forecast out in 2008 for the 2009 market, and then we segued that in 2010 to a 20 to 25-year bull market. That's what we said in 2010. We're sticking with that call. Between 2009 and today, Scott, we've had 4 or 5 different types of bull markets, right? Remember, the beginning stages of this bull was all low-quality, high-beta stuff. Then we had the climb, the wall of worry. Then we had the Trump bull market. Now I think we've entered into year 1 of Goldilocks, and I think we're going to have a couple of years of Goldilocks. When I sit down and talk to my clients around the world, they have no clue what Goldilocks is. So I have to explain that to it. I think 2019, quite frankly, is this generation's 1995.
So what are you talking about? Growth, no inflation? That's the principle.
I think
part of what Goldilocks feels like right now.
Yes,
the economy's going to do well enough. You've got no inflation to speak of. Rates are low. Where else are you going to put your money? Type of thesis?
Yes. I think you take a look at a whiteboard of investments, right? And you take a look at emerging markets, no, fundamental problems. Europe, no, the next Japan. China, fundamental demographic problems. The United States and Canada, for that matter, North America is the best house in an increasingly volatile neighborhood.
You don't need to throw a bone to the home team. They got it. It's okay.
I have to throw a bone in the team. Canadian banks, go. But no, I think that we are entering into this nifty 50 brand-oriented now. Unfortunately, different from the 90s, right? The new consumer staples are Apple, Google, Facebook, Microsoft. It's not General Mills or Campbell Soup anymore. Those are the new consumer staples.